This is a brief overview of derecognition of held-to-maturity, available for sale, and trading security investments. Derecognition is pretty much the same for every chapter, as you are probably figuring out. You remove the accounts related to the asset being sold or disposed of or maturing, and then you're going to recognize any gain or loss through the income statement. For simplicity in these explanations and for our purposes in Chapter 12, I am not going to give you examples here or on an exam where you also have to calculate accrued interest revenue at the sale date, but understand in the real world this would be very likely. Pretty much the same story in Chapter 12. If you indeed hold a held-to-maturity security to the end, you will get cash for the face amount at the end, and when you record the cash, you'll remove the bond investment account and there will be no gain or loss. If you sell a held-to-maturity security early, you will record a gain or loss because it's highly unlikely that you will sell the security for the same amortized cost you have in your books. Right? This would only happen if the interest rate you use to price the investment in your amortization schedule is the exact same interest rate being used by the market to price the bond on the day of the sale. Not going to happen. Once you remove the bond investment account and any remaining premium or discount account and record the cash received in the sale, you will know whether you have a gain or loss by looking at what you need to balance the account. Remember, credits to balance are always gains and debits to balance are always losses. If you sell an available for sale security, you will remove the investment account and any remaining premium or discount, plus you will remove the fair value adjustment account balance. And for available for sale securities, you will also need to reverse out all of the unrealized gains and losses that have gone into OCI. When you include the cash received in this entry, you'll essentially be left with a gain or loss that goes through the income statement that'll be equal to the difference between the amortized cost and the cash received. If you sell a trading security, you will remove the investment account and any remaining premium or discount, plus you will remove the fair value adjustment account. You don't need to reverse any unrealized gains and losses because they've already gone through the income statement. You may have an additional gain or loss due to market price changes since the last time you made a fair value adjustment, but that should be the extent of it. You have activities that walk you through this. Big picture is what you've seen in other chapters. Remove all of the accounts so that after the disposal or sale or maturity, there are no stray account balances left on the balance sheet related to this investment.